Want to know the top 5 investment strategies for 2024? We're about to dive into a gold mine of expert insights that could help you navigate the financial seas of the upcoming year. From diversification to dollar cost averaging, value investing, growth investing, and the classic buy and hold strategy, we've got you covered. Whether you're a seasoned investor or dipping your toes in for the first time, these strategies could be game changers. Stay tuned to find out the top investment strategies that could shape your financial future. First up, we have diversification. So, what exactly is diversification? Well, in the simplest terms, it's a strategy that mixes a variety of investments within a portfolio. The rationale behind this technique contends that a portfolio constructed of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. Now, Warren Buffett, one of the most successful investors of all time, once said, "Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing." This might seem a bit harsh, but let's unpack it a bit. What Buffett is saying is that if you're an expert in a sector and you truly understand it, then diversification might not be as beneficial. But let's be clear, very few of us are Warren Buffett. For the majority of us, diversification can be a powerful strategy. So, how does diversification work? Well, it's all about spreading your investments across different asset classes such as stocks, bonds, real estate, commodities, and so on. The idea is to mitigate risk. If one sector or asset isn't performing well, others might be doing great, balancing the overall performance of your portfolio. But diversification isn't just about risk mitigation. It can also enhance returns. How so? Well, different assets perform well at different times. By diversifying, you can capture returns from various sectors and investment types, creating a smoother, more consistent return pattern. Now, it's important to remember that diversification isn't a one-size-fits-all strategy. It's crucial to diversify in a way that aligns with your financial goals, risk tolerance, and investment horizon. This might involve a mix of domestic and international investments, or a balance between growth and income assets. In conclusion, while diversification isn't a magic bullet, it's a proven strategy that can help most investors navigate the ups and downs of the market, mitigate risks, and potentially enhance returns. As the old saying goes, don't put all your eggs in one basket. Remember, diversification is all about spreading those eggs across multiple baskets. Next on our list is dollar cost averaging. Picture this. You're a runner preparing for a marathon. You wouldn't sprint the entire distance, but instead maintain a steady pace. The same concept applies to investing through dollar cost averaging, or DCA, for short. Simply put, DCA is an investment strategy where you consistently invest a fixed amount of money in a particular investment, regardless of the price at the time of purchase. Now you might be asking, why would I want to do that? Well, let's consider the words of the great Benjamin Graham, who once said, "The investor's chief problem, and even his worst enemy, is likely to be himself." This statement rings true for many investors who struggle with the psychological hurdle of market timing. It's easy to be swayed by market fluctuations and make impulsive decisions based on fear or greed. That's where DCA comes into play. By investing a fixed amount regularly, you buy more shares when prices are low and fewer when they are high. This strategy eliminates the need to time the market, which can be a daunting task even for seasoned investors. Over time, this can potentially lower the average cost per share of the investment. Think of it as a disciplined approach to investing. Rather than trying to predict market highs and lows, you're committing to a consistent investment schedule. It's like setting your investment journey on cruise control. You're not swayed by market volatility, and you're not trying to outsmart the market. You're merely participating in it, consistently and systematically. But remember, like any strategy, DCA isn't foolproof. It doesn't guarantee profit or protect against loss in declining markets. But it can help manage risk and mitigate the impact of market volatility on your investment. So let's sum it up. Dollar cost averaging is a simple yet powerful strategy that can help investors overcome the psychological challenge of market timing. It's about consistency, discipline, and long-term commitment. It's not about getting rich quick, but about building wealth steadily over time. With DCA, consistency is key. Our third strategy is value investing. The essence of value investing lies in its name. It's all about finding value. Value that is often overlooked or underestimated by the market. It's like being a treasure hunter, sifting through the sands of the financial market for hidden gems that are undervalued. This strategy is deeply rooted in the principles famously championed by the Oracle of Omaha, Warren Buffett. He once said, "Price is what you pay, Value is what you get. And that's the core of value investing. It's not about chasing hot stocks or following market trends. Rather, it's about thorough analysis, patience, and the courage to swim against the current. Value investing is more than just buying cheap stocks. It's about understanding the intrinsic value of an investment. Intrinsic value, in simple terms, is the actual value of a company or an asset based on an underlying perception of its true value. This includes all aspects of the business in terms of both tangible and intangible factors. This strategy requires a deep dive into a company's fundamentals, including its earnings, dividends, assets, and liabilities. It's about looking beyond the numbers, at the company's management, its competitive position, and its potential for future growth. It's a meticulous process, and not for the faint-hearted. But for those willing to put in the work, the rewards can be significant. But remember, like any strategy, value investing isn't foolproof. It requires patience and discipline, and it's not always easy to stick to your guns when the market is moving in a different direction. The key is to keep your emotions in check and stay focused on your long-term investment goals. Value investing is all about investing in companies that are undervalued by the market, but that have strong fundamentals and the potential for growth. It's about finding those diamonds in the rough, those hidden gems that, given time, will shine brightly and provide a strong return on investment. Value investing is all about finding diamonds in the rough. Moving on, we have growth investing. Now, this is a fascinating approach that focuses on companies expected to grow at an above-average rate compared to other companies in the market. It's all about capital appreciation, my friends. It's about looking for those companies that are poised to grow. Here's a wonderful quote from the renowned investor Phil Fisher that really captures the essence of growth investing. The stock market is filled with individuals who know the price of everything, but the value of nothing. This underscores the importance of understanding a company's intrinsic value, rather than just its current price tag. Growth investors don't just buy stocks, they invest in future potential. They're looking for the next big thing, the companies that are going to shape our world in the years to come. It's not about the present, it's about the future. In growth investing, the future prospects are key. Our final strategy is buy and hold. Immortalized by the investment guru Warren Buffett, who once said, "Our favorite holding period is forever." The buy and hold strategy is a long-term investment approach that focuses on buying quality stocks and holding on to them for an extended period of time. The beauty of this approach lies in its simplicity and patience. It's about resisting the urge to react to short-term market fluctuations and instead having faith in your investments over the long haul. This strategy is built on the belief that, in the long run, good companies will grow and bad news will eventually be overshadowed by the company's intrinsic value. Moreover, the buy and hold strategy can offer significant tax advantages. By holding on to stocks for more than a year, investors can benefit from reduced capital gains tax rates. In essence, the buy and hold method is not about timing the market, but time in the market. Remember, patience is the companion of wisdom in buy and hold strategy. To wrap things up, we've journeyed through the top 5 investment strategies for the coming year. We've delved into the benefits of diversification, the steady approach of dollar-cost averaging, the patience required in value investing, the potential in growth investing, and the long-term vision of the buy and hold strategy. Each has its unique advantages. Remember, the best investment strategy depends on your individual financial goals.